Another big interest rate cut from the Bank of Canada, although Tiff Macklem seen as signalling a slower pace of rate cuts moving forward. Our guest says labelling this a hawkish cut is a bit of a stretch. Let's bring in David Rosenberg, founder and president of Rosenberg Research. It's great to see you.
You too, Andy.
You feel the fundamental message, though, from the Bank of Canada, when you strip away the verbiage, is that rates are headed down from here.
There's no doubt in my mind rates are still headed down. It's really, when it comes down to these statements, it's about, the cadence and the pace. I'm most concerned about the destination. So, I think as everybody has been saying all day, the era of 50 basis point cuts is over, most likely. So they'll shift towards 25 basis points. They might even skip a meeting here and there, but the direction is still down. And that's a high conviction call. So basically, in terms of the verbiage, yeah. So why would they cut rates another 50 basis points? They've done a lot already. 175 basis points? I mean, since June. So they've done a lot of lifting. And the signal is that they're going to do some more, but at a slower pace, and that's just fine.
Randall Bartlett, the economist at Desjardins, thinks that ultimately we'll get to 2% on the benchmark rate, down from 3.25%. Does that seem too drastic to you?
Not at all. That's a great call. And I'll tell you why. Because the bank continues to signal the reality that we are in a disinflationary output gap at a time when most underlying inflation measures, and I look at the CPIX, which is the inflation rate that excludes the 8 most volatile components of the CPI, and I know that that's the Bank of Canada's preferred measure, that's at 1.7%. It's been at or below their target for 8 months in a row. And we know that the unemployment rate of 6.8% is above any measure you would estimate for full employment in Canada. So we have an output gap. The output gap is actually widening.
And David, that means slack in the economy.
Slack in the economy.
Sorry,
I'm pretending I'm an economics 101 professor.
Sorry, go on.
So the excess capacity at a time, it's not as if we're coming at this anymore from 4 or 5% inflation or 3% inflation. The disinflationary output gap or the excess capacity is widening at a time when underlying inflation is actually already below target. So what do you do as a central banker? Okay. I don't think Macklem wanted to have the markets all of a sudden go front run them and start pricing another 50 basis points. So he wants to manage expectations. 2%, I think 2% is a minimum because their range of the neutral policy rate is 2.25 to 3.25.
And we're there now at the top end.
We're at the top end of the range. But the thing is that we are still in an environment of excess supply in the economy, and that excess supply is getting bigger. So you have to get the policy rate below the estimate of neutral. Now, you could look at what's the midpoint, 2.75. I think 2% is a good call. And I'll tell you something else, because patterns matter, that in the last 5 rate cutting cycles by the BOC, they stopped at 2% or lower on the policy rate. So 2% sounds pretty radical. But I'm pretty sure that 9 months ago, if we said that we're going to be sitting, at 3.25 when we were at 5, you'd be saying, "Oh, come on, that's too radical." No, I think 2% or lower is where we will finish up, and probably by the second half of next year.
So when you say excess capacity in the economy, are firms finding it hard to raise prices? Workers can't get jobs?
Well, it's in the data, 100%. Firstly, on the inflation, like I said before, virtually every inflation measure that's important to the Bank of Canada is running below 2%. I mean, when you strip out mortgage interest, and I always wonder, how is mortgage interest costs in the CPI? Like Andy, when you go shopping with your wife and you're at Loblaws, do you say, "Hey, honey, can you get the mortgage interest next to the Cheerios?"
But it is part of the cost of living,
yeah, but it's not a price anybody really pays. It's not a source of inflation. It's not a demand-related item.
Okay.
But anyway, that aside, I mean, inflation's running below 1% when you strip out mortgage interest, and people will say, well, you're stripping out more. What it's telling you is that 95% of the pricing pie is running not just below the Bank of Canada's target, well below. And that's telling you about what's happening with pricing power broadly speaking, in the business sector. You mentioned about employment. It's very interesting, isn't it, that we haven't had carnage in terms of employment losses, right? But what's happening is we can continue to get an influx of workers into the labor force. So what's happening here, so from a wage perspective, and now what we're seeing finally is wage growth is starting to slow down, as you would expect with slack emerging in the labor market. So for example, in the past year, half of the people that came into the labor force looking for a job, only half of those people have found a job. You go back a year ago, and 3/4 of the people coming into the labor force were finding a job. You go back 2 years ago, more than 100%. That's how things have shifted. And that puts downward pressure on wages. That when you have a situation, where the labor force is running so far ahead of the employment growth, well, that's when you start getting the rise in the unemployment rate. I mean, we're at 6.8. We're up a percentage point in the past year. We're up 1.7 percentage points in the past 2 years. And that, by the way, is a 100% ironclad recession indicator.
That's a what? Sorry, David.
Yeah, a 2-year rise in the unemployment rate of 1.7 percentage points. That is a ironclad recession. We were either historically going into recession, or coming out of recession with that degree of slack emerging in the labor market. Now, I know that Tiff Macklem said that, doesn't think that there's a recession. But then again, if I were in his shoes and I'm reporting into the finance minister, I'd probably say the same thing. Stephen Polo's, meanwhile, his predecessor doesn't have the political shackles. Said last week, yeah, I think we're in a recession. I could say we can argue it's debatable, okay, and the arbiter of the recession calls in Canada. It's not Stats Canada, but there's different variables, different orders of magnitude on what defines a recession in Canada. But I would say that 8 quarters in a row of declining real GDP per capita. I mean, that's basically it. 1.5% year-over-year GDP growth, but population is running 3.5%. So negative real GDP per capita. That to me, if it walks like a duck. Yeah, CD Howe Institute, that's what I was trying to say. They're the arbiters of the recession call.
Jay, we're very tight for time. If Trump puts on big tariffs, I mean, one alternative we have is to devalue or let the Canadian dollar devalue down to, you say, maybe 62.5 cents US.
I'm glad that you read my daily note. Yeah, well, what is the, people ask me all the time, what's the retaliation? Well, through the currency. So I think that what happens if we get the 25% tariff, increase, the dollar goes down to 62 cents, and rates come down even more. And even if we don't get the tariff hike, the trend is still your friend. Rates are still coming down, and the dollar is still going down, just not that dramatically.
David, thank you very much. David Rosenberg, founder and president at Rosenberg Research.